it's hard to get away from tariffs and geopolitical comments or impact on the stock market, the economy. Everyone is thinking about it. And I tend, I've said before, I got rid of my TVs, and I try to keep things apolitical. I figure you can get your political commentary wherever you want to get it. And I try to focus on the economy and the stock market. But now what's happening is that the market and probably the economy is all colored by geopolitical. In this case, tariffs and trade restrictions and counter tariffs and raising tariffs and lowering tariffs. It's all about tariffs and the impact that they have on the economy and on the stock market. The stock market, which responds much more quickly than the economy, has been going up and down and up and down, and for part of this period of time actually moving more in a downward direction. And so I can't get away from that. So, but I still try to make it apolitical as much as I can. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 1st, 2025. Now, along with my theme of trying to be apolitical, the most apolitical person I listen to is Mohammed El-Erian. He just doesn't get into it. And if he does, it's a neutral comment. And so I'm playing him, and he is going to be talking about tariffs and their impact on inflation and rate cuts. And this has to do with the economy, but it ultimately has, the stock market has a response to it as well. This is Scott Wapner from CNBC interviewing Mohammed El-Erian.
Mohammed El-Erian is Allianz Chief Economic Advisor, joins us now. It's good to see you again.
Thanks for having me, Scott.
I'd love to get your current view of these markets.
So the good news is we got some pretty nasty technicals behind us. The markets came into this year, as you know, betting on two things. One is continued U.S. exceptionalism, and two, the good things, as you put it, would happen at the same time as the less good. And those two bets were undermined and caught quite a few people overexposed to the U.S. markets. So you've seen quite a deleveraging among fast money, and you've also seen a shift of institutional to Europe. I think most of the deleveraging is behind us. The shift to Europe isn't quite behind us, but the technicals certainly are not as bad as they were a few weeks ago.
So, I mean, do you think this U.S. exceptionalism theme is still a thing? Because I can't tell you the number of people who come on the network, certainly my programs, and talk about better value in Europe. You're going to get way better returns over there. You're probably going to get a little less risk as well. How do you see that?
So I don't quite buy that because people have bought into announcements in Germany. Implementation is a completely different kettle of fish. So to go from announcement to implementation is quite hard. I also think that the inherent strength of the U.S. economy and the U.S. markets are still there. There's this massive cloud of uncertainty over them right now. But if and when that cloud clears, people will focus back on the inherent strengths.
What was your takeaway from the Fed meeting last week? We still have two cuts on the table. You take the growth forecast down, you raise the inflation forecast a bit, and for now it appears that the Fed chair is going to look through any inflation caused by tariffs. They even brought out the transitory word again.
They did. So you had two different interpretations. If you focused only on the statement, the forecast, and the interest rate guidance, this is a wait-and-see Fed that is taking seriously the soft data. And it is the soft data that has been worrisome. If you listen to Chair Powell, this is someone who doesn't take the soft data as seriously as the rest of the Fed. And this is someone who's willing to dismiss the tariff effects on inflation as transitory. You know, it's up to you which one you focus on. I think you should focus on the first one. I think the market still believes that we're going to get more cuts than we will. I think at best we will get one cut, and it wouldn't surprise me if we get no cuts this year, Scott, unless we go into recession. But that's a completely different ballgame.
I mean, 1 versus 2, I could see some wiggle room there. In terms of the soft data, I wonder what you do think about that, a number of the surveys, consumer especially related surveys, have been weak, which the Fed chair really dismissed. And I think that's what you're alluding to. It's like I'm not going to pay so much attention to a survey that says I feel bad about the economy until I actually see it show up in the hard data where people are, in fact, spending less. It's not something to clearly worry about. Are they too dismissive of the so-called soft data?
They are, Scott. When people say, I see it in the soft data, but I don't see it in the hard data, well, there's a lag. There's normally a lag of 3 to 6 months. You may be continuing to invest, you may be continuing to buy, but if you get more and more worried, the soft data is going to flash yellow, and the hard data will pick that up in a few months. Same with the price data. So if you look at surveys of inflation, again today we had another one. They are all consistently pointing to inflation going up. So I think the Fed should take it more seriously. The trouble is it puts their two mandates into competition. Do they fight the fear of high unemployment, or do they fight the fear of higher inflation?
So this is a piece that is done, it's a general piece. It was not timely for this week or last week, but it's done on Bloomberg. And again, it's on tariffs. And they make the case that the big items, the biggest item is autos. Particularly when you're talking about Mexico and Canada, and to some extent Europe. And pharmaceuticals are also included because most pharmaceuticals are made in other countries. The video is full of questions. Full. They're not making many statements. They're saying, I wonder about this, and how's this going to work, and so forth. So, and that's where we are, that the market is dealing with uncertainty. We don't know. We just don't know. There may be people with opinions. I don't know. But I think it's generally understood that tariffs and trade restrictions do slow down the economy. And if it slows down the economy, it slows down the stock market. The detail of that, how far down the market goes or how far down the economy goes, do we go into a recession or a protracted recession? I don't know. But anyway, this is from Bloomberg, but it's actually being broadcast from Bloomberg Europe. And so I'll share this with you.
Well, you pointed out there that the markets are still digesting the auto tariffs and the kind of bid from this week that you started seeing from the Trump administration. The auto sector is so crucial anyway because not only has it already been struggling from kind of this overcapacity really from so many places, bringing back even potential consolidation within the industry itself, but it has so many moving parts and really reaches a global platform. We've talked about how the auto kind of consumption story in the United States is an energy story, a raw material story, but also one that has deep connections to that of Canada, Mexico, Germany, even the UK a little bit, something that Rachel Reeves had talked about and addressed in her interview round yesterday as well, not to mention, of course, the Asian automakers that you were seeing on your screen at the moment. We'll put in Stellantis there as our Italian kind of bid on the auto space as well. So this is crucial as the kind of, as you said, opening salvo. We should also mention that when he was initially threatening these auto tariffs, he talked about pharmaceutical tariffs as well. We haven't heard that piece of it yet. And pharmaceutical is, of course, also a really big piece of the European ecosystem as well, from the Scandinavians to the likes of Novo Nordisk to the likes of Sanofi over in France as well. So there are a couple of other sectors that are potentially coming down the pike. And that's going to be really crucial in terms of how you do it. I think from a market's perspective now, you are starting to think about this as, is there a tariff premium baked into the way some of these stocks or bonds for these companies are trading?
Yeah, really good point in terms of what could be happening in terms of the sector-by-sector basis. To what extent is the auto story a template if you're an investor in pharma names in Europe? And do you want to start putting in similar pricing action in expectation of a similar game plan coming through from the Trump administration? Talking of which, April the 2nd, the language around this, the signalling has shifted. Where do we stand on what to expect next week?
Well, we're wondering where what the math actually looks like here, because all we really know is that not only are reciprocal tariffs coming, but they're going to be calculated by not just barriers that are already existing from a lot of countries, including kind of protectionist measures that are pre-existing for decades, but also what Donald Trump calls non-tariff barriers as well. That looks like VAT, that looks like regulation as well. The question for a lot of investors, and I think for a lot of economists and analysts, is how do you quantify the impact of regulation? For example, tech regulation is a great one. So one of the big questions here is that if you do get an X amount of tariffs or reciprocal tariffs as it's being called on April 2nd, what levers can the UK, can the EU, can China, can India actually pull, especially right here in Europe where regulation is such a big one? Another follow-up question to that is also if the end goal of these tariffs are to ultimately bring down the regulation that American companies feel abroad, if they successfully do that, if somehow you see European regulators pull back on some of the red tape for international companies, does that mean the U.S. will do the same? Does that mean the U.S. will pull down the tariffs? And that's the signaling that we haven't gotten yet.
Then back to CNBC, and again, more on tariffs. I'm trying to play the best pieces I could find. It's not something that maybe you've heard, but maybe a little different take on it. They're going to talk about the tariffs on autos, focus primarily autos. This is more of a pessimistic view. Since I don't know, I know that the impact of tariffs on autos, for example, clearly that's negative. To what extent it impacts labor or the economy, the stock market, I don't really know that. But I think taking a pessimistic view of it is appropriate, at least for right now. My hope is that longer term, that we'll get through this and it'll have less impact and we can move on with a positive economy. But that's an opinion. I don't know.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States.
25% tariffs that the president announced on imported cars as well as parts starting next week.
For some automotive industry economists, the unthinkable has happened. 30 years of free trade across North America virtually wiped out by a single executive order.
Of course, I don't think anyone could have foreseen this happening.
There are all kinds of unintended consequences that will fall into place.
One executive in the industry texted me earlier and he said, this is going to drive the auto industry into a recession.
While there are a lot of possibilities and much is unknown, one thing's for sure. Cars are about to get more expensive in the US. Some may even be pulled from the market entirely.
If we see prices going up as a result of costs going up either on vehicles or parts, that means that the consumer is going to have a harder time affording these vehicles. And we estimate you could see a 2.5 to over 3 million unit hit.
Now we have to invest in new plants. We have to invest in new assembly lines. We have to find new suppliers. This is going to drive some small suppliers out of business. This is going to cost more to build vehicles. This is going to eliminate entire segments of vehicles from the pipeline.
All of that will likely take years to execute. Analysts say the US can't even build really cheap cars domestically. While a lot of automakers, foreign and domestic, have factories in the US, almost half of all vehicles are imported from other countries: Canada, Mexico, and countries across Europe and Asia. Not everyone is going to be affected the same. Ford and Stellantis, for example, build 74 to 80% of their US market vehicles at home. GM, less than half. But every car has at least some of its parts or materials made or procured outside the US. And even companies less affected are likely to charge more.
The United States loses all the things that Canada and Mexico bring to the table. Canada has a great wealth of natural resources, and Mexico offers great workers and lower cost. We're able to compete with the EU and better compete with China. And when you consolidate it to just the US, our volume isn't there.
And finally, still on CNBC, Steve Leisman is an economist, and he and Kelly Evans are she's an anchor, they're kind of co-hosting this piece on the economy and the market. Their focus is primarily on the 10-year Treasury, the rate. and the rate has been falling. And it looks like to me that is going to continue to fall. I don't think it's dropping a lot, but it's sliding down, and which means the price of bonds is going up. And they make the point that this is not so much about the Fed, although the Fed does control those rates, but it's more about how the consumer interprets the decline in those interest rates, or let's go all the way back over to tariffs, or the impact of tariffs. If the consumer says, I'm not going to spend money because I'm uncertain about my job, I'm uncertain about my income, or the interest rates, or something, yeah, all of that has an impact on the stock market and the economy. And I think we're seeing the beginning of it. Again, I don't know how long it's going to go, but for now, I think in the short run, the view is negative, and that's the way the market is interpreting this. So take a listen to Steve Leisman and Kelly Evans.
Frances Donald is here with us. She's always got a spicy take on things. She's RBC Capital's chief economist. Frances, so where do you think the market is casting its vote right now?
Well, this is a market that doesn't like the econ data, but I might suggest this isn't just about today. We are facing, as Steve said, a huge amount of fog when it comes to tariffs, and it's real difficult to look at any data point and not make a broad proclamation about what it means for the U.S. economy. It's only the starting point for this new transition the U.S. economy is heading into. So when I look at U.S. inflation data today, I'm not thinking, oh, are we seeing signs that tariffs are coming into play? We're just at the very beginning of the tariff story. And the problem is we're starting out at 2.5% inflation, even without the inflationary shocks coming ahead. This is a market that's going to have to really become aware of the fact that a 3% handle on inflation this year is not out of the realm of possibilities.
I know, but the 10-year is down 10 basis points. We've gone from 436 to 426. I don't think that's the way it would behave. Right? I mean, maybe I should look at the shorter and maybe put back that chart, show the 2-year, show the 5-year. I don't know if we're flattening. We could talk to Rick about that. The 2-year also lower, 391. I mean, the yields are coming in. They're telling us this is a slowdown
but Kelly,
story.
Put yourself on the Fed.
Yeah. I love to think. Yeah.
Do that. Put yourself on the Fed. Governor Evans. When are you going to be cutting rates?
Well, see,
what is the inflation doing at the time when you're cutting rates? As if Frances is correct, and I think everybody has the same forecast, you have additional inflation coming through from tariffs.
Right.
Even if you think they're one time.
If you get one bad jobs report,
boom, you think the Fed forgets the inflation numbers.
And jobless claims, which to be fair, have held up fine. They're absolutely fine outside of maybe the federal layoffs. But
let's ask Governor Donald.
Donald, what do you think?
I got to jump in here. We are accustomed to using all the economic data and saying, what does it mean for the Federal Reserve? I am spending way less time thinking about the Fed than I ever have in my entire career, because this U.S. economy doesn't need 2-year rates lower. It needs 10-year and 30-year rates lower. And the Fed is not the one that's going to create major influence there. The corporate sector, the housing sector, those are really leveraged to the long end of the curve. So my focus going into work every day is, what is that 10-year doing? When are we going to get relief for housing? And when are we going to start to see some alleviation in the burden of some of those higher levels of debt among consumers and households? That's not going to be what's happening with the Fed. It's going to be the market's interpretation of where growth is heading and what's happening in Washington. So we got to pivot the conversation a little bit away from the Fed, even though, of course, as an economist, it's my favorite thing to talk about. No.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And if you have not subscribed, I would appreciate you to hit the subscribe button and subscribe to my channel. Thank you.